Hi guys, I'm Phil Town from Real One Investing, and today I want to talk to you about how stock prices are determined in the stock market. Well, if you're new to investing, the way stock prices are figured out, how they end up in the stock market at a certain price, may seem a little bit of a mystery, right? They go up, they go down, people make money, people lose money. But what really causes these prices to change? I'm going to tell you, it's actually a lot simpler than you may think. So today I'm going to explain how stock prices are determined and how that impacts your investing decisions. So first off, a company has to go public before the public can actually see that it's priced on a daily basis. That means the company goes through what's called an IPO, an initial public offering, where an investment bank like a Goldman Sachs or Morgan Stanley agrees that this company has the qualities that are being valued in the public stock market, number one, and number two, that it has enough of a value that it makes it worth investing in as a public stock. In other words, it's got to be big enough or they can't really take it public very well. So when that company, like a Goldman Sachs, gets with the management of this company that wants to go public, they determine through what's called a roadshow what price they can put on that stock. The roadshow happens when they go around the country very quickly. In a couple of days, they fly jets around the country with this management team, and they talk to their brokers, and their brokers tell them what price they think they can get for that business. Okay, so that's essentially how they decide to set the price. They start putting it out there at, let's say, $25 a share before they ever go public, and the brokers start to pre-sell that price out there and say, "Would you guys be interested in this at 25 a share?" And they find out there's a tremendous amount of interest. They raise the price above 25. If there's not much interest, they might lower it a little bit or cancel the IPO altogether. So that's how it goes public. Now, as soon as it goes public, let's say 27, then immediately it's in what's called the secondary market. So the first pile of money that comes in from all the people who have said, yes, I want to buy that at the IPO, that money goes to the company. Now, once that company's public, the stock starts to trade on the public markets. The company doesn't get any of that money, but it's very interested in making sure that the stock price moves up, because so much of what that company will be able to do in the future in terms of using its stock options to reward employees, in terms of selling more stock to get more cash to do more things with, to grow, in terms of borrowing money from banks, all of those are going to be determined by what's happening with that stock price. So they're very interested in seeing that price go up. Now, generally speaking, the stock price is going to reflect supply and demand. So that's just very generally speaking. But there are lots of factors that affect the supply and demand of a stock price. One of those factors is basically how much net income and free cash flow this company is creating, because ultimately, stocks should be priced according to the ultimate amount of cash that the stock's going to produce over time that's discounted back to today at some discount rate that reflects the risk of investing in that stock. So let's say you're going to have $1 million worth of cash flow over the next 15, 20 years. What would you pay for $1 million coming in over that period of time? That's the question that an investor might ask. And the answer is, I don't know, it depends on how much risk there is that I won't get the $1 million. And so they'll calculate that and figure out a price. And that's, of course, a little bit how they go public with it, and a little bit about how the public looks at it. That's how they start looking at it. Now, from that point, then it gets to be a bit of a game. If the stock price is moving up, it's going to attract more investors, not because the price reflects the ultimate cash flow anymore, but because other investors are buying it. And now the speculation starts. The price of Google starts to go up, more people are going to buy Google. If it keeps going up, more people are going to buy Google. This is called momentum investing, and it's basically the way most of the market prices things. Once that stock gets a reputation for going up and up and up and up, then more and more and more people are going to buy it. And by the way, if the stock ever doesn't meet its expectations in terms of quarterly earnings, in terms of what it's telling the public, then everybody could get scared and start to sell the stock. And as the stock price goes down, you have anti-momentum. You have the counter-cyclical, and it's going to really affect that stock price as well. So ultimately, what affects stock price is greed and fear. Those are the two things that are really triggering the stock price. Once it gets out there, it stops behaving like people really care about the ultimate cash flow and starts behaving with greed. Momentum is carrying this up, and fear. Oh my God, it's going to go down. Now, we take advantage of that as investors because we know that events can impact that stock price. If there's an event where something really good happens, the stock price is likely to go up. But the ones we're looking for are the scary events. The well burst in the Gulf of Mexico. There's a huge revolution going on that's affecting the cotton prices, and t-shirt companies are scared. So these events can have an impact on the price of a stock, driving it down for no good reason long term, but short term makes a lot of sense to exit that company because people get scared. So the investors exit. We wait patiently for this to happen, and we like to buy these great companies when they go on sale. Now, the way we calculate that we should buy a company is essentially that there's a stock price and then there's the intrinsic value of the business. Those two things are different all the time. In the long run, the stock market tends to price things at their true intrinsic value. But in the short run, anything can happen. So if there's a big fear event, the stock price can drop far below the intrinsic value, and suddenly we find ourselves able to buy a $10 bill for $5. That is fantastic, and that is the kind of investing we love to do. Now, I'd love to hear from you guys. What are some of the companies you guys are interested in right now? And wow, what price should they be at? Leave a comment below with your answer, and I'll be sure to follow up with you. And thanks for watching. Now go play. You guys, if you enjoyed this video and you feel it was valuable in teaching you more about how stock prices are determined, hit the like button and share this video with your friends. And if you want more investing content, subscribe to my channel, and don't forget to click the button on the screen for a free gift. Thanks again for watching.